Hello and welcome, I'm glad you could join me for this video. This isn't going to be necessarily fun and it's probably going to be a bit dry, but I want to talk about the T word. Tax. I'm Nick, and before we start I just want to say I'm not an accountant, I'm not a financial advisor. Anything in this video is just my own take on how the tax system works, and I'd advise you, if you've got any queries or questions, to speak to a professional, speak to an accountant, make sure you're getting the right answers you need. I'm just someone posting videos on YouTube. The tax system in the UK is quite complicated and it's always changing, so this is just going to be a basic summary of how taxes work. But everything in this video is only really relevant to England and Wales. Tax systems throughout the world are all different in certain ways, and that includes Scotland and Ireland. See, I've invested for 13 years now, and the tax system can be that complicated that even I don't do my own taxes. I get an accountant, I pay them to check everything for me, so I'm making sure I've done it right. Therefore, if I'm using an accountant, I recommend you guys use an accountant as well. So as you might know, the tax year runs from the 6th of April one year to the 5th of April the following year. So, fun fact number one. So the system for paying tax yearly was actually introduced in 1752 on what was then New Year's Day, being the 25th of March. There were a few issues with this, leap years being one, that caused the full cycle of paying tax yearly to go out of sync every few years. So the actual date of paying tax, the actual date of the tax year ending on the 5th of April was introduced in 1800. So within investing, the main types of tax that you're going to encounter are likely to be income tax, capital gains tax, and dividend tax. Each are taxed in different ways and at different rates. These can and do often change, even yearly, so I would strongly advise, even watching this video, within a few days it's been released, just go online and just double check what the rates are payable at the moment, so next year it could be different, last year they were different. Just make sure you check what the current rates are for the current tax year we're in. The other type of tax that we'll encounter is stamp duty. There are two different kinds of stamp duty that we will encounter. One is from property and one is from buying shares. Stamp duty land tax is for the tax you pay when you buy a property. The rates on that do vary. They have been changed recently to try and encourage more people to buy, but they're going back to the sort of standard rate as of next year. The stamp duty you pay on shares, that's only on UK shares, and that's fixed at 0.5% of the transaction value, no matter how many you're buying. As we're trying to earn money that is not through normal employment, we will have to file a tax return at the end of the financial year for anything we've earned that has not come from our sort of usual day job employment. Anyone who is in employment is most likely to be on the PAYE scheme or pay as you earn. With pay as you earn, you are taxed at source, or the tax comes off your money before you receive it. So when you look at your pay slip, you can see what you get paid and what you actually receive are quite different, and that's because you're being taxed. However, on the upside, it does save you from having to do your own tax return and file your own taxes, which is probably a benefit, and it's better for you not to have to do it. Fun fact number two. PAYE was introduced in the UK in 1944. By Sir Stanley Paul Chambers. Right, now we've got through all that, let's get down to the brass tacks. Get it? Brass tacks. So, income tax. This is the tax you're most likely to be paying on anything you've earned money on, from interest in a bank account or savings account up to rent that's paid by a tenant. However, there are some tax exempt accounts, such as ISAs, which you don't pay any tax on at all, but that's a separate topic and a separate video. Before you start paying tax, you do get a personal allowance, which is an amount of money you can earn before you have to start paying tax. And for this current financial year, which ends in April 2021, your personal allowance is £12,500. But again, as I said earlier, these things change. This number could change for next year as well, so it's always better to check it before you do anything. However, with a quick summary of the current income tax rates for tax year 2020 to 21, you're paying 20% tax on everything over £12,500 all the way up to 50 grand, which isn't a bad thing. £50,000 is a good salary, and if you're only paying 20% on most of that, it's not so bad. When you start to get past that, anything over 50,000, you're looking at paying 40% tax on, and that's on any earnings up to £150,000. Then you get an eye-watering 45% tax on anything you earn over 150 grand. Which is a lot, but I wouldn't complain earning 150 grand a year. Why not? So as I said, with income tax, you are taxed incrementally depending on how much you've earned. So let's look at a little example then. We'll say you've earned £55,000 all in for the year. All income, nothing, additional on top of that, just to make things simple. So first things first, we'll take the £12,500 allowance we currently have off, which will leave us with £42,500 to be taxed. So from that, there'll be £37,500 that will be taxable at 20%. And then the remaining £5,000, because it's over the £50,000 threshold, you will be paying 40% on that. So all in all, with the calculations, at 20% you'll be paying £7,500 in tax, and at the 40% you'll be paying £2,000. So in total you'll be paying £9,500. And from £55,000 earning, and that works out to be about 17.3% tax that you've paid. Capital gains isn't quite as straightforward as income tax. Capital gain is defined as when you dispose of an asset for a profit. Disposed of is defined as selling, giving away or gifting, swapping it for something else, or getting compensation for it. If you sell or give away an asset for the same or less than what you paid for it, you are not making a gain, and therefore there is no taxable gain to be had with that. And this also helps if you want to offset other gains you've made. If you sell something for a loss, you can offset the loss against the gain that you've made somewhere else, only with capital gains. Just like with income tax, you get a personal allowance with capital gains tax as well, and for this current tax year that is £12,300. Again, this can and will probably change from year to year, so it's always best to check and make sure you're getting the right allowance for the correct tax year. So the taxable rates on this are different to income tax, but they still fit with the same values. So if you earn over 50,000, you're paying a higher level of capital gains tax, and obviously below there you're paying the basic level. So the basic level of capital gains tax at the moment is 10%. However, if it's in the disposal of a property, it's 18%. And for the higher rate taxpayer, you're paying 20% on your capital gains, but if it's a property, you're paying slightly more at 28%. And on the upside, there is no additional higher rate tax band on capital gains as what there is for income tax. And we've got dividends. Dividends again taxed differently to the other two. Still the same thresholds, but it's all based around the sort of threshold limits for the income tax. However, this is purely for income generated from dividends. And just like the two before, you get a personal allowance of how much you can earn from dividends before you're paying tax, but this is all the way down at £2,000. Now, £2,000 isn't great as an allowance, but tax-free money is tax-free money. But the basic rate taxpayer pays 7.5% on dividends. So that's, considerably better than the 20% you start off with income tax. However, if you fall into the higher rate of taxpayers, you're paying 32.5% on your dividends, which is, it's still a little bit lower than the higher rate in income tax, but that's a massive jump between the two. And if you move all the way up into the higher rate taxpayer, you pay 38.1% on your dividends. So just so you know, that was the easy bit done. The complicated part is when you get a combination of 2 or 3 of them within the same tax year, because all these have to be compiled onto one tax return, and you need to know in which order and which tax band you're going to fall when you have to pay the tax on everything. I am, however, going to have a good go at simplifying this down, just so you can sort of follow the basics of working out what taxes are going to be paid on what sort of earnings you've generated throughout the tax year. So the first thing to do is to work out what your sort of taxable earnings are for that year. So the easiest way to do this is to work out your total earnings in terms of income and take off any of your income allowances that you'll have. Then do the same with capital gains, work out the total capital gains you have, take away any capital losses, then take off your capital allowance, and then finally do that with your dividends. Add up your total dividend income, take off your dividend allowance, and you just add the 3 together, and that will give you your total earnings for the year. Fairly simple now. Now you know how much you've earned, you will know what bracket of tax you're going to fall in, so we know where we're going to be aiming for in terms of how bad the tax bill is going to be. So let's take that £55,000 income that we had earlier, but now we're going to add to that. We're going to add £14,000 worth of capital gains and £3,000 worth of dividends. We're going to assume for the purpose of this that the capital gains is not from a property sale. So we'll give it a go with a basic tax calculation just for you to have a look at, sort of very basic level of how this is all worked out. So the first thing to do is we'll work out the total earnings that this person's had in the last year. So we've got our 55,000 plus 14,000 plus 3,000 gives us £72,000. Not bad. I'd say £72,000 a year. It's alright. Now this is going to determine what band of tax we're going to fall into, and as we've surpassed that £50,000 threshold, there's going to be higher rate tax paid on this income. So just like the example above, we'll start by taking the allowances off each of the 3 sources of earnings, just so we know what is going to be taxable and what fits into our tax-free allowance. So now we've taken the allowances off, we are left with £42,000 worth of income, £1,700 of capital gain, and £1,000 worth of dividends. The way I understand tax to be calculated is everything stacks on top of each other, starting with income, then capital gains, then dividends. So therefore, all the capital gains and dividend income that's come in is going to be charged at their respective higher rates, as the total for the year has surpassed £50,000. So your taxable income is the same as what it was in the previous example, as the money's not changed. And with your capital gains, there is £1,700, which will be taxable at 20%. And the £1,000 on your dividends is going to be chargeable at 32.5%. So let's work out those totals then. Your taxable income was £9,500. Your taxable capital gains is £340, and your taxable dividends is £325, giving you a grand total of £10,165. So this works out of a total earnings tax bill of 14.1%. This isn't so bad, looking at some of those percentages and how high they were getting up to. But again, this is on the very basic level. If you are currently employed as well, you're going to have that income to account for everything else as well. This is when it starts to get very complicated. So once again, please speak to an accountant if you have any proper queries or questions about the tax. So I hope this has made it a little bit clearer for you. I hope I haven't muddied the water further for you. But if you've got any questions, please just let me know, pop them in the comments below. But like I did say, if it's a tax specific question, please just speak to an accountant. They're going to be able to advise you much better than I could. But however, a quick summary of what's gone on. Usually, in most circumstances, you'll be paying 20% on income tax and 7.5% on dividends. One thing I always make sure I do is I maximise my personal allowances, just to make sure that if there's an allowance I haven't taken advantage of in that year, I will do what I can to ensure that I've used it, just to try and save myself a little bit of tax this year. And obviously, if I save the tax this year, I won't be paying it next year either, which is always good. I always try and focus on dividend income as well, as with it only being 7.5% tax that you pay on the lower rate, you always want to maximise that and try and keep your capital gains and income lower, and that way you'll end up paying, or hopefully paying, a bit less tax. And just a quick summary on capital gains. This only occurs when you dispose of an asset, so it's not going to be something that's going to happen regularly. It's only going to be happening, once in a while, or if you are regularly selling properties or shares or other sort of valuable assets, then this is something that you need to look at and potentially structure the way you earn money more tax efficiently. Again, speak to an accountant. So yeah, everything in this video is more tailored around how I structure my tax, because this is what works best for me. It might not work best for you. There might be other ways that work better. The way I do things might be really bad for you, and it might cost you more in tax. So I'd always say, every situation's different, and just seek the advice that you should be getting. Well, we got to the end of that, didn't we? I hope you've stuck around this long, and I hope what I've said has been informative for you. And if it has, I would really appreciate you just clicking on that like button, just to let me know and others know that you've enjoyed the content, and hopefully it can spread around to other people who just need a little help and pointing in their right direction with things. And also, if you haven't subscribed to the channel, please subscribe, and also click the notification bell, just so every time I make a new upload, you'll be notified of that as well. Well, I hope you've enjoyed your time here, and I hope to see you again in another video. But in the meantime, learn, invest, success.